Hi, I'm Colleen Taylor with TechCrunch TV. Here with me in the studio today is Ryan Caldbeck, the founder and CEO of CircleUp, and he's here to talk to us about the Jobs Act that is expected to be signed into law by President Obama today and how this will affect Silicon Valley and startups and the business ecosystem at large. So welcome, Ryan. Thanks for being here with us.
Thanks for having me.
So the Jobs Act has a lot of moving parts to it, and you are sort of an expert in this space because you're running a company that has to do with crowdfunding and group fundraising. And also you have a long career in the finance industry, so we're happy to have you here to elucidate some of what's going on. So can you just tell me what this Jobs Act, what the big things are here and what this means?
Sure. There's several pieces of the Jobs Act. Crowdfunding is one of them, and that'll be important for certain companies in certain industries, but there are a couple other important pieces of the Jobs Act as well. Title I of the Jobs Act is basically an IPO on-ramp. It helps companies go public more easily, and that'll be really important, especially for smaller technology businesses. Another piece of the Jobs Act lifts the general solicitation prohibition that's currently in effect. So companies that are raising money, private companies, cannot advertise that they're doing that. This piece of the Jobs Act will lift that general solicitation piece for accredited investors. And then the piece of the Jobs Act that's probably getting the most attention right now is around crowdfunding, and that's what CircleUp, our business, does. So the Jobs Act will allow unaccredited investors to invest through registered portals into private businesses.
Great. And unaccredited investors, that means people who don't necessarily have $1 million in assets, don't necessarily make more than $200,000 or $300,000 a year. So this really opens up the ability to invest in companies to a huge segment of the population.
That's right. That's right. And a lot of folks are really excited about that. Investors are excited about the access that this will give them to diversify their portfolio. Companies are excited because this will allow capital to flow more freely. The critics, I think, have appropriately pointed out that restrictions are needed. Regulations are needed to protect both the investors and the companies. So over the next 270 days, the SEC will take a look at the Jobs Act and say, okay, what are the additional restrictions that we need to have here to make sure all parties involved are protected?
Okay, so I can't just, after this Jobs Act is signed in today, regular people can't just go and invest tomorrow in their favorite startup.
Correct. Yeah. So accredited investors today can use portals that focus on accredited investors. So for example, CircleUp today works only with accredited investors. Unaccredited investors will have to wait 270 days. Other parts of the Jobs Act, so the general solicitation prohibition will be lifted in 90 days, and the IPO on-ramp is effective basically immediately.
Okay, and so I know that you talk to a lot of sort of angel investors. You're pretty plugged in here. What are people saying about this? Are they nervous now that anyone can be an angel investor, and what's been the response?
Both sides. There are some angels that are really excited about what this will do for small businesses, especially outside of Silicon Valley. You know, the consumer products companies of the world, the services companies, the companies that are a little bit less sexy but still major drivers of our economy, those are the companies that struggle to raise money. And this crowdfunding component of the Jobs Act will help those companies raise money more easily.
Okay.
There are other angel investors that are very cautious about the restrictions that are going to be needed. And I think they're excited to see what comes out of the SEC rulemaking period.
Okay. And then I want to talk about IPOs as well, because I think a big part of this is that the 500 shareholder rule will no longer be in existence. And we've reported a lot here at TechCrunch that that's a big reason why Facebook has filed its S1 and is looking to go public, because they bumped up against that 500 shareholder rule. And now that's not going to be an issue anymore.
They're raising it to 2,000, 2,000 accredited investors, and I think 499 unaccredited investors. And that will allow companies, whether it's the Twitters of the world or others, to stay private longer, which I think is a good thing for businesses of that scale. I think where where some other companies might run into trouble are the much smaller businesses. So you can imagine a $1 million company or $2 million company, for them to deal with 1,000 investors, whether they're accredited or unaccredited, would be very difficult.
Okay. And in general, it seems like the tech industry has been very supportive of the Jobs Act. I mean, there are people like Steve Case, the founder of AOL, Mitch Kapoor, Google as a company, they've all gotten behind this. Why do you think this has been so embraced by Silicon Valley?
I think folks of most industries have been really excited about this. I think in Silicon Valley, many people see the benefit of the IPO on-ramp and allowing technology businesses to go public more easily. They see the benefits of the other components of the Jobs Act. But I think they're also excited that this fundamentally should spur job growth. People like Steve Case, are excited about the angel investment that this will create, but also the job creation that will result. And so, a component for all proponents of the bill is certainly, how does this help the tech industry, or how does this help a certain industry? But I think all of them are also Americans and are excited about the job creation.
Okay. And then to be devil's advocate here, though, I mean, this does, as you mentioned earlier, kind of open up the floodgates in a lot of ways. And this could be very dangerous. I mean, there's a reason that these limits have been in place for a while. They want to protect regular people from losing their fortunes that they've built up, their small fortunes over their lives. What kind of regulations do you think still need to be in place to make it so that people don't get burned now? Yeah,
we were most excited about a piece that came out of the Senate bill, which was requiring the portals to be registered, likely with the SEC. We think registration of these portals is critical, so that you can't just have someone throw up a website and quickly raise money without any background in the securities industry. Fundamentally, these portals are helping issuers sell securities. And with that comes a lot of responsibility and requires a lot of knowledge of how that's done in an appropriate way. So we were excited that that was one restriction. That restriction will evolve. There may be another governing body other than FINRA, which is created to watch over these portals. But initially, we think that it's appropriate that FINRA take hold of that. I think restrictions that have also been talked about and are part of the Jobs Act now are around unaccredited investors being limited on how much they can invest based on their income. We think that that's appropriate. It's difficult to say how much they should be allowed to invest. But putting caps, I think the current cap right now is if you make more than $100,000 a year, you can invest 10% of your income. The SEC will take the next couple months, next 9 months, and figure out what level of income, what level of investment is appropriate for unaccredited investors. But that's something that I think is really appropriate. And then I think the last thing that I hope the SEC focuses on is transparency. It's difficult for me to imagine how the SEC can require certain pieces of information from the company. But fundamentally, what I think they can require in an appropriate way is transparency in the process and allowing the investors to communicate directly with the entrepreneurs, allowing the investors to communicate with each other. And so now, when you're making an investment in one of these portals, you can see what concerns the other 100 people that are looking at it have. And that level of transparency, we think, will help take out some of the fraud. We think that fraud lives in the shadows. And by shining some light on that through this transparency, we think that should help. That's interesting that you're saying, because it sounds like you're saying you want CircleUp to have to be registered. You're excited about that, about making it so that your company is regulated in a way. I mean, most CEOs don't really embrace more regulation. We think long-term this industry doesn't exist if there isn't credibility around it. And credibility will be built in part by requiring the industry participants, the portals, to meet certain regulations to be able to help issuers sell securities. So we think it's an important component of what should come out of this process. Cool. And so can you tell me really briefly just about CircleUp? I know you guys aren't live yet or not launched to the public yet, but
tell me a little bit about how it's evolved and,
Sure.
and what you guys are going to be doing over the next few weeks and months?
Sure. So CircleUp is launching April 18th. We are an equity-based crowdfunding platform that focuses on accredited investors. And we help match accredited investors with small private consumer product and retail companies, the types of companies that have historically struggled to raise money from angels, but are still great national brands. So we're launching in a couple weeks. At the end of this SEC rulemaking period in 9 months, we'll reevaluate whether or not it makes sense to allow unaccredited investors. But in the interim, we'll work with accredited investors and help the companies raise money.
Okay, sounds good. Ryan, thank you so much for joining us, and best of luck with CircleUp. Keep us posted on how things go.
Thanks a lot for having me.